Good morning, everyone. Welcome to the Blue Kurtik podcast. This is Nikith Mudasani, your host and founder of Blue Kurtik. Today is July 21st, 2026, just a few hours before the market open. If you only looked at the headlines last week, you'd think the market was falling apart. Semiconductor stocks had their worst week in more than a year. Hedge funds dumped tech at a pace we've genuinely never seen before. And short interest on the S&P 500 is sitting right at an all-time high. But here's the thing. Underneath all that noise, something quietly improved. For the first time in almost 6 months, more than 70% of S&P 500 stocks were trading above their 200-day moving average. That's a breadth signal, and historically it's a pretty good one. We'll get into exactly what that means and why it matters in a minute. Today we're covering a market that's sending some genuinely mixed signals. Chips got crushed, then ripped higher just as fast. Positioning data shows investors bailing on tech at a record clip, and meanwhile, money market funds are quietly bracing for more Fed uncertainty. Let's get into it. Before we begin, a quick reminder. We publish this podcast here only twice a week, but our premium members get access to a fresh market podcast every trading day before the market opens on the Blue Kurtik website and app. Along with the daily podcast, you'll also get access to our proprietary market research, in-depth insights, videos, charts on the street, and much more. If you'd like to stay ahead of the market every morning, download the Blue Kurtik app or visit our website to learn more. The story of the last week or two has really been about semiconductors. The sector, which has been the poster child for the AI trade, went through its worst stretch in over a year. A lot of that came down to two things. Investors started questioning whether the valuations in AI infrastructure names had gotten ahead of themselves, and there were growing doubts about whether the big hyperscalers, the Microsofts and Amazons and Metas of the world, would actually keep spending at the pace the market had priced in. Then, just as quickly as it fell apart, the sector snapped back. Chip stocks staged a strong rebound, and that rebound helped drag the broader market higher. Nasdaq 100 futures rallied 1.3%, S&P 500 futures climbed 0.5%, and an exchange-traded fund tracking major semiconductor names jumped 4.1% in pre-market trading. Samsung and Taiwan Semiconductor led Asia's benchmark to its first gain in 4 sessions, and technology stocks outperformed in Europe as well. So what changed? A lot of it comes down to positioning, not fundamentals. UBS's trading desk put out a note arguing the sell-off in momentum stocks may be nearing its end. Their reasoning was pretty specific. Hedge funds had already cut long positions in momentum and semiconductor names by about 5% of gross market value, which is one of the largest reductions on record for that measure. That pushed net positioning in semis and software back down to where it was in April. In other words, a lot of the speculative excess had already been wrung out before the rebound even started. Michael Romano, who heads hedge fund equity derivative sales at UBS, framed it as a signal to start buying the dip, though he was careful to say investors should scale in gradually rather than rush back all at once. He also pointed to something notable. UBS's momentum gauge had a dramatic intraday reversal, swinging from a 3.5% loss to a 2.5% gain in just 2 hours. That kind of violent swing usually tells you positioning was stretched in one direction and snapped back hard. Worth noting, this isn't a call that's without risk. Romano's own team flagged that if AI and momentum stocks do recover, it could come at the expense of the sectors that have been leading lately, like banks and industrials. A lot of the recent buying in those cyclical sectors actually looks like short covering rather than fresh conviction, so there's a real chance we see money rotate back out of them and into AI names if this rebound has legs. Let's go back to that breadth number from the top, because it's one of the more interesting data points we've seen in a while. Over 70% of S&P 500 stocks traded above their 200-day moving average, the first time that's happened in close to 6 months. That matters because it tells you the rally isn't just being carried by a handful of mega cap names. More stocks are participating. Looking at history, there have been 17 prior instances where breadth improved this sharply after a similar setup. In 14 of those 17 cases, the S&P 500 was higher 2 weeks later. That's not a guarantee of anything. Past patterns don't always repeat, but it's a meaningfully positive base rate. At the same time, positioning data is telling a more cautious story. Goldman Sachs's Prime Services desk found that hedge funds pulled back from U.S. tech stocks at a record pace over the past 2 months. The fund cohort was a net seller of the sector in 6 of the past 8 weeks, and the cumulative reduction in market value came to about 10%, the largest retreat from tech since Goldman's data series began more than a decade ago. The S&P 500 Information Technology Index has fallen roughly 10% since early June as investors took profits and grew more skeptical about whether AI valuations can hold up. A lot of that money has been rotating into more defensive areas like consumer stocks. Within tech, the selling wasn't even. Technology hardware, storage and peripherals, and IT services were hit hardest, while semiconductors and software saw comparatively less selling pressure. Then there's short interest, which is sitting at genuinely historic levels. Short interest in S&P 500 stocks is just steps away from 3.79% of free float, an all-time high in data going back to 2010. For the broader Russell 3000, that figure recently hit 6.3%, also a record. On the New York Stock Exchange specifically, short interest has been climbing since February and hit 9% of shares outstanding in late June, a record there too. For context, that compares with about 5% during the global financial crisis and roughly 6% during the COVID pandemic. One strategist described the recent move in short interest as having, quote, gone vertical. What's interesting is that this hasn't exactly been a profitable bet this year. The S&P 500 is up about 9.3% so far in 2026 and has climbed 18% from its late March low. But short sellers have kept adding to bearish positions anyway, which tells you there's real underlying anxiety about how much further this rally can run, even as it keeps grinding higher. Some of the most heavily shorted names in the Russell 3000, companies like Hertz, EOS Energy, and Dave & Buster's, have actually dropped 15% on average this year, while the rest of the index gained close to 21%. So shorts haven't been right everywhere, but where they've been right, like with Hertz, which is down 65% this year with nearly 80% of its shares sold short, they've been right in a big way. Interestingly, hedge funds have been moving in the opposite direction on single stock shorts specifically, covering those positions at the fastest pace in 3 months. So you've got this split picture, broad index level shorting near record highs, but funds pulling back from betting against individual companies. Zooming out to the macro picture, a lot of what's driving positioning right now traces back to uncertainty over the Fed's next move under Chairman Kevin Warsh. A surge in oil prices combined with a more hawkish tone out of the Fed had traders pricing in a possible rate increase as soon as this month. But then a pair of benign inflation reports last week muddied that outlook and prompted markets to walk back some of those expectations. That uncertainty is showing up clearly in money market fund behavior. Funds overseeing more than $8 trillion are shifting toward ultra short-term holdings and away from anything with meaningful interest rate risk. The weighted average maturity of fund holdings has fallen to 40 days, down from 45 days back in mid-May. Managers have been directing more cash into overnight repurchase agreements and short-dated securities, while also increasing exposure to floating rate agency and treasury debt. Deborah Cunningham, who oversees global liquidity markets at Federated Hermes, summed up the logic pretty simply. Funds want to keep some flexibility so they can reinvest at higher yields if rates do end up moving higher. A lot of this caution also traces back to early 2022, when some managers got caught holding longer-dated positions right before the Fed kicked off one of its fastest tightening cycles in decades. Nobody wants to repeat that mistake with a Fed path this unclear. The numbers back this up. Repo allocations from money market funds rose by about $36 billion in June to roughly $1.89 trillion. Holdings of Treasury floating rate notes hit a record $523 billion in June, as managers look to capture elevated 3-month Treasury bill yields without taking on extra duration risk. Meanwhile, Treasury bill holdings actually fell by nearly $105 billion last month, even as the government kept ramping up bill issuance. Separately, Federal Home Loan Bank debt outstanding has grown by about $180 billion this year, including roughly $140 billion in floating rate issuance, and money funds have increased their overall agency holdings by about $195 billion over that same stretch. The takeaway from Wells Fargo strategists is that, with a possible September hike still on the table and plenty of hawkish commentary coming out of the Fed, money funds are likely to keep shortening their maturities from here. As one of them put it, there's a pretty high bar right now. for managers to do anything other than park cash in repo or floaters if they can help it. On the semiconductor side specifically, there's a notable development out of Taiwan semiconductor manufacturing. According to Nikki, TSMC has been in discussions with clients about raising prices by as much as 10% starting in 2027 in order to offset rising costs for manufacturing materials. The talks reportedly involve hiking base prices somewhere in a 5 to 10% range and could apply to both advanced and older generation or mature chips. This comes on the back of TSMC raising its own spending and revenue projections for 2026 earlier this month, a sign the company expects the current boom in chip and data center demand to keep going well into 2027 and beyond. Given that TSMC is the primary chip maker for both Nvidia and Apple, any sustained price increase would have ripple effects across the industry, though it's worth being cautious here since these are still reported discussions rather than confirmed pricing changes. Looking ahead, the market's attention is about to shift toward big tech earnings, which will double as an update on AI capital spending plans. Alphabet reports this week alongside Tesla, and then Microsoft, Meta, Apple, and Amazon follow next week. Semiconductor companies report throughout the rest of the season, which keeps the industry in focus well into August. As one macro strategist at Lombard Odier put it, the question the market is asking has shifted. It's no longer about whether AI demand actually exists, it's about whether pricing, margins, and cash flow can justify the capital spending that's already gone into it. If the answer is yes, the rebound in these names could broaden out. If not, we're likely to stay in a higher volatility regime. On the geopolitical side, oil has been a major swing factor. Brent crude dipped 0.5% to just below $89 a barrel after surging almost 6% over the prior 2 days, as the US and Iran continued exchanging strikes for a 10th straight day. Goldman Sachs analysts warned that Brent could spike above $120 a barrel by the fourth quarter if disruptions to the Strait of Hormuz continue, though that's explicitly not their base case. Goldman's actual forecast has Brent at $80 in the fourth quarter, with risks skewed to the upside given the current situation. There's also a separate and somewhat under-the-radar disruption building at the Panama Canal. The Panama Canal Authority is moving to temporarily suspend part of its vessel booking system, citing water supply challenges tied to a potential El Niño weather pattern. Daily booking capacity for the canal's larger Panamax class locks is set to drop from 36 to 34 vessels starting July 25th. Gatun Lake, which feeds the canal's locks, currently sits at 84.6 feet, just below its 5-year July average, and is projected to keep falling toward 83.8 feet by late September, more than a foot below normal. This matters because it adds a third global choke point to worry about, alongside the ongoing disruptions from the Iran conflict around the Strait of Hormuz and the threat Houthi forces pose to shipping through the Bab el-Mandeb Strait. During the last El Niño event in 2023 and 2024, monthly vessel traffic through the Panama Canal fell from a peak of over 1,500 vessels down to just over 1,000 at its low point. If this year's El Niño turns out to be as severe as forecasters are suggesting, and the U.S. Climate Prediction Center has said it could be one of the strongest in more than 75 years, we could see a meaningful hit to global shipping capacity layered on top of the Middle East disruptions that are already in place. Put together, the combination of record short interest, a historic pullback in hedge fund tech exposure, and elevated volatility around AI infrastructure names all point to a market that remains nervous even as it grinds higher. The improving breadth reading is a genuine positive, but it doesn't erase the underlying uncertainty. Earnings season and the geopolitical backdrop are both likely to be the deciding factors for where this goes next. So to bring it all together, breadth quietly improved last week even as chip stocks had their worst stretch in over a year, and history suggests that kind of setup has tended to lead to higher prices 2 weeks out, though obviously that's not a guarantee. Hedge funds pulled back from tech at a record pace, and short interest across the market is sitting at all-time highs, which tells you there's still plenty of skepticism baked in even as the S&P sits up over 9% on the year. On the macro side, the Fed's path under Chairman Warsh remains genuinely unclear, and money market funds are positioning defensively as a result. And overseas, both the Strait of Hormuz and now the Panama Canal are adding fresh uncertainty to global trade flows. The next real test comes from earnings. Alphabet and Tesla kick things off this week, followed by the rest of big tech next week and semiconductor names throughout the rest of the season. How those companies talk about AI spending and whether the numbers back up the price tag will likely set the tone for the market well into the fall. That's it for today's episode. Thanks for listening, and we'll catch you in the next one.